Rally on Wall Street taking a breather as investors wait for a busy week of earnings and plenty of other issues on the horizon, including the election. Our next guest is watching the breadth of this rally, and so far he's not concerned that it's mostly dominated by tech. Joining us now is Jurrien Timmer, Fidelity Investments Director of Global Macro. Jurrien, it's good to see you. So you say here, Jurrien, this is not like 1999, and you spell out reasons why the broadening you say so far has been fairly benign. What are those reasons, Jurrien?
Well, good afternoon. And yes, of course, memories of the late 90s abound when we see the Magnificent Seven domination of this bull market, at least until recently. And so, but when you dig under the hood, the real issue with the rally until the summer, right, when the Fed got the green light to ease, the market has broadened very nicely. But until that point, you worry about, seven stocks making up a third of the market cap. What happens if they sell off? Can the market survive? And we actually saw back in July, when we had that yen carry trade unwind happen, is that they did knock the market down. The market actually fell 10% over the summer. But it's nothing like what we saw back in the 90s. That really was an extreme. And I'll give you just an example. In the last year of that bull market, the S&P rose more than 20%, yet 3/4 of the stocks in the S&P actually declined. I mean, think mathematically how hard it is to pull that off. And then when those Nifty 50 back then traded lower, and they were trading at twice the PE of the rest of the market didn't have a chance, right? Even though you had a very broad rotation into everything else. This time around, the breadth has been pretty good. 80% of stocks in the S&P are in uptrends. It's just that they lag behind the Mag 7, but they were still going up. So it's a far less dangerous or concentrated scenario than what we saw back then, and that's why I do think it's possible that the market can rotate and broaden in a bullish way. And over the last few months, that's exactly what we've seen.
In terms of headwinds, now you just mentioned the election, and some people don't even think that is going to be much of a headwind, maybe because we talk about it so much, but that or anything else, what do you see going into the end of the year as potential sticking points for equities?
Well, obviously, bond yields are still front and center. I mean, you mentioned earlier that yields are up 11 basis points today at 418. And they do cause little wobbles. I mean, I wouldn't even call today's action in the stock market a wobble because it's just one day. But if we go back a couple of years, 2022 was a massive reset in the cost of capital. And then last year, October, when the 10-year pushed against 5%, it caused the market to wobble 10%. And again, this spring, similar thing happened. So we're back to kind of the old days of the 60s, 70s, and 80s when the Fed model worked. And when yields go up a lot, it tends to put the squeeze on the stock market. It doesn't have to derail the bull market, but it certainly can slow it down. So that's one thing that we're seeing. And in this era of potential fiscal dominance, where we have ongoing large deficits, and especially where the central bank, the Fed, is not monetizing those deficits, at least not right now, it does put pressure on yields. And I do think that that's a story we're going to see from time to time. The other issue, of course, you mentioned the election. Our investors always ask me, should we worry? What should we do? And the history is pretty clear that over a 2-year period from the election to the next midterm election, which often will course correct any kind of lopsided outcome. During that 2-year period, the election outcome can and does matter, right? I mean, who's in the White House, whether it's a sweep or a divided Congress. So I'm not saying that those things don't matter at all. But over a full 4-year cycle, so a full presidential cycle, and you slice up the election any way you want, Democrat, Republican, sweep, gridlock, it makes virtually no difference in the return for the market. So if you're a long-term investor and you have the patience to kind of sit out a full term, it really doesn't matter what the election outcome is, at least from the market's perspective. Over time, the markets are going to do what they're going to do. It's a $50 trillion stock market. That's a big number to move.